Hello and good evening, everyone. Thank you for logging into the webinar. My name is Gaurav, and today we have with us Rohit, partner at Kotak Cherry, and the Grip Invest team, Nikhil and Vaibhav, to discuss the new ways of investment in fixed income space. I'll hand it over to Rohit, but just a note to all our participants, if you have any questions, do post it on the Q&A box, and our panelists will take it at the end of the session.
Yeah. Okay. Thanks, Gaurav. Hi, Nikhil, Vaibhav. And thanks everyone for logging in on the call. Good that we don't have an India match today. Otherwise, we would have had very less audience. So thanks again for logging in. So let's start quickly, immediately. Okay. So Kotak, obviously, all of you know about, and I represent Kotak Cherry, which is the digital investment platform of Kotak. I will talk more about Grip, but before we start, let me give you a quick intro of both Nikhil and Vaibhav. Nikhil is the founder and CEO of Grip. He started his career as an investment banker with Morgan Stanley, where he advised on M&A and fundraising to large Indian and both Indian and global corporates. Subsequently, Nikhil co-founded Chalo, one of India's largest mobility startups, which today facilitates over 1 billion passenger rides. Wow, that is some scale, Nikhil. He has also served as a consultant for 2 years to the World Bank. We also have Vaibhav on the call. Vaibhav is the Chief Business Officer at Grip. Over the last decade, he has held leadership positions scaling early stage startups, both in India and the US, while operating at the cusp of creating structured financial products, accessing private wealth ecosystem, and building consumer brands. So welcome, Nikhil and Vaibhav on this call. And I'm really keen to hear from you what are these new ways of fixed income investing that you're talking about, because this is one endeavor which we also have at Kotak Cherry, which is the traditional avenues of investing obviously are available to all investors. But there are certain asset classes which so far were available only to, let's say, institutional investors or very, very high net worth individuals. But with the advent of technology, they have been kind of democratized and are available to a normal retail investor as well. So why don't we start quickly, immediately, Nikhil? I have also personally spent almost 15 years in capital markets and investment management. And in your experience, if you take a very macro view and a bird's eye view, how is India investing? So, this entire 140 crore, of which maybe there are different varying numbers. There's a 10 crore demat accounts and 4 crore, 5 crore mutual fund investors. But at an aggregate level, how is our country investing? So how do you look at that?
Sure. First of all, Rohit and Gaurav, thank you for having Vaibhav, me, and the Grip team as part of this session. It's a pleasure to talk to your users and share more about fixed income investing and how we have seen it evolve over the last few years. To talk about your question, we've got some data points here. I think I'll talk about each one of them, and some of these stand out, have always surprised me whenever I have looked at the number, because some of the common wisdom doesn't suggest it, right? The first one is really about how much Indian households have as investments. There's nearly 30 lakh crores of savings that Indian households own today in various assets. That's the number one, and it is a fairly astonishing number. It's trillions of dollars for a country like India. The second one that always stands out to me is the allocation to fixed income. While equity is a growing space, as a country, it does seem to suggest that we prefer fixed income as a form of investing. Even if you look at insurance, which is another 17%, a lot of that has to do with security, right? And hence almost 90% of Indian investor portfolio is linked to some kind of security or surety or predictability of returns rather than taking an equity risk. One of the big reasons why we at Grip wanted to think about fixed income was because that as a product is a preference for us. Within that fixed income bucket, within that 70% bucket of fixed income that you see on blue on this slide, a majority of it lies in fixed deposits, which are bank saving deposits, a lot of it also in current accounts, or accounts that don't necessarily even make the fixed deposit rate. You've not necessarily put a recurring deposit, etc., into it. The question we naturally ask ourselves is what may have caused it. Historically, if we leave the last maybe 10 years out, India was a place where the cost of finance or the rent or the interest paid to investors for a deposit was actually very, very high. And even that product was itself very attractive from a perspective of not just savings, not just safety of capital, but actually generating returns. And hence, historically, that has built up in our minds as a very attractive investment option. Continues to be that. There is no better way of keeping your money safe. But one of the challenges that we hear a lot of users talk about now is what has transpired really in the last 10 years and continues to be applicable today. As the Indian economy has matured, very normal to happen, the FD returns have started to reduce. Banks have been able to pay far lesser to be able to get CASA, current account savings accounts. And today the spread between a FD rate, pre-tax FD rate, which is the line in green here, and the inflation rate has become narrower, which means that on a post-tax rate, assuming you are in your 30% tax bracket, even at a 20% tax bracket, your returns on your FDs are actually below the expected inflation rate. What it basically means is that trillions of dollars lying in FD today are not even matching up or not keeping up to the real returns that are required to keep your money relevant. Okay, and that is a question that has prompted the discovery for alternative investment options, both on platforms like Cherry and obviously on platforms like Grip. So this is sort of the historical basis. This is where we are today, and what it has made us, ask a very simple question, and this question comes from our users: is FDs are great for protecting my money, and I must have an allocation to them. Right? I'd love to get your views as well, but you must have an allocation to them. However, for a certain part of my money, where can I invest it in fixed income, where I can get substantially higher returns? I understand that comes with some level of risk, but my list should be marginally higher. The returns should outweigh the risk, right? And that answer is really what Grip has been on a journey to find.
Okay. Good. So Nikhil, actually, you made a very interesting point about how FD rates have obviously coming down over the period. I remember, there was a time in 5 years you could have doubled your money in an FD, right? Which is no longer the case. Actually, why 5 years? Even lesser than 5 years at some point in time. And maybe that prompted that behavior in the generation prior to us. I look at FDs or other different asset classes slightly differently based on my limited experience that I have had. See, when you're creating your personal portfolio, okay, it is almost like creating a cricket team. So you need to have all kinds of players in the team for your portfolio or your team to be effective. Okay, you need a smashing batsman, who can take care of the power plays. You also need that stable batsman just in case the pitch is bouncy and the ball is seaming around. Okay, you need spinners, you need fast bowlers, you need all around. So all kind of players are there. Fixed deposit is that stable batsman that Rahul Dravid in your portfolio. कैसा भी pitch है, कैसा भी मौसम है, it will not let you down. Okay, so that is number one. That does not mean that you should have 11 Rahul Dravids in your team, right? So you need Sehwags also, and you need Kohlis also, you need Kuldeep Yadav also. So that is the important point, that for the stability in your portfolio, fixed deposits is a must. And this is something which I keep on telling to whoever comes to me for advice, that as soon as you start earning, the first thing that you should do is put some money in a fixed deposit, which might sound counterintuitive to some people. Today, we have seen, large part of our younger earning generation, they are first starting with futures and options, right? Whereas SEBI data is showing that 90% of all traders are losing money. On an average, they are losing 50,000 rupees in a country which has 2,500 per capita USD income. This is something which we cannot afford to lose, but unfortunately that is the case. So you start with fixed deposit. What is the ideal amount that you should invest in fixed deposit? First, have your emergency portfolio built. Okay. It can be, let's say, 3 months of salary to 1 year of salary. I personally keep 6 months of salary. That you put it in an FD and then you just forget about it. You should never touch that amount unless there is actually an emergency, God forbid. After that, you should start thinking that, yes, I have some more surplus now. What should I do? Depending on your risk appetite, depending on your investment horizons, your goals, etc. And it is very, very personalized. So there is no one size fits all solution. Let's say equity markets are doing great, but you have no risk appetite to see even 5% drawdown in your capital. Okay, because let's say you're saving for your son's education. Your son is in class 10, in class 12, he'll go to IIT, IIM, or your daughter will go to some middle college. You are saving for that. So obviously that money you can never invest in equity, even a 5%, 10% drawdown, which is very much possible. You cannot afford. So the answer is very, very personalized. But the answer is also not to have everything in fixed deposit. But then, as I said, your team is incomplete. Your team is Rahul Dravid is a great player, but you cannot have 11 Rahuls in your portfolio. So now, leading from that, Vaibhav, I just wanted to ask you that what is the investment behavior? GRIP, and we'll talk more about GRIP slightly later in the section. Can you tell me a little bit more about what kind of products you are offering on your portfolio? Nikhil just mentioned that there is a possibility of having products which have slightly higher risk, but the returns kind of outweigh. And portfolio management is all about this, that what is the additional risk you are taking and what is the extra return you are making. So can you just share your thoughts about what is GRIP doing, where you feel that investors, it's a compelling opportunity for investors?
Yeah. Firstly, thanks, Rohit, for having us. It's an absolute pleasure to be on a platform with Kotak Cherry. Just taking from where Nikhil left and then you left, right? Where you said you have made your first investment journey through FDs, and then you have figured out your emergency funds, and then you look for something which provides higher returns with a marginally higher risk. And that's what the question we started with. And then we went on a pursuit to find or create that instrument which would essentially provide this exceptionally high or higher returns while taking marginally higher risk. It is also important to understand that we don't want to chase, headline returns without understanding the risk. For example, in your example itself, FNO is probably very high returns, but the risk is equally high. And in this journey is where we stumbled upon this instrument called SDI, which is a securitized debt instrument. We will just take a few moments later to go into those details. But if I put it very simply, it is like a customized bond to achieve better risk reward objectives. If you just see on the left side of the screen, we spoke about FD, that dependable investment that you do gives you 6.5%. But when you are starting to look for your next investments, could there be a product which immediately jumps up your returns by 2x? While we are creating these SDI products across the credit rating spectrum, these SDIs provide returns anywhere between 11.5% to 16%. And just on the screen, we had taken a midway around 13%, which is quite a significant delta over your FD portfolio. While keeping in mind the risk that is associated with it. So FDs, at least the bank FDs, are AAA rated, which is risk-free or 0% default rate. You take a slightly higher risk where it is 2% default rate. These SDIs are still rated between AA to BBB and significantly increase the portfolio returns or alpha in your portfolio. I was still thinking about like how to put this in your analogy. So Rahul Dravid becomes your FD, and maybe someone who takes exceptional risk becomes your opener, but maybe this is the Virat Kohli of the cricket team, where there is a calculated risk. We never say that it is absolutely risk-free. There's a calculated risk with significantly higher returns. Yeah, Nikhil, could you? And when we were thinking about finding this instrument, one of the most important things, or one of the first things that was on our mind, was that it has to be fully regulated instrument. SDIs are fully regulated as instruments because they came out of SEBI's framework. SEBI created this SDI framework, and we just capitalized on it. So it's a fully regulated instrument. And secondly, SEBI has now also approved this as an instrument to be offered on platforms like Grip and Kotak Cherry. And the framework there, it is called OBBP license. So the instrument came out of SEBI frameworks, hence it is fully regulated. And now the platform, Grip as a platform, has also secured this OBBP license. So both the product and the platform are fully regulated. Just understanding how does an SDI
Sorry,
work?
I'll just take a minute here, Vaibhav, before you kind of explain what an SDI is. Really keen to understand that. Nikhil, I'll take a second and take the screen. I'll project the whiteboard. Just projecting the whiteboard. And I'll show you how, at least when we try and explain to investors how to think about portfolio construction and where instruments like SDIs or bonds kind of come in. Is it visible, the whiteboard?
Yes.
Yeah, okay. So, yeah. So let's say, sorry, my drawing is really bad. This is a normal graph, okay? And let's say this is the risk axis. And this is the return axis, okay? Now, FD will be somewhere here, okay? Extremely low risk, but low return, FD. So let's say very low risk, close to zero risk. In India, there is no history, no commercial bank ever has lost money for investors. In fact, in a couple of years back, there was some problem in some banks, but still no FD investor has ever lost money in India. And equity will be somewhere here, which is higher risk. So let's say your FD will give you 5-6%, 7% return. Equity in the long run will give you 16, 17, 15% return. But obviously there will be those volatility, right? You cannot be sure that in each year you will definitely get 15%, but historically we have seen those kind of returns come. This entire space is vacant. So what are the options? I can actually settle for 7% and with zero risk. Or I can take some risk and go to this 15-16%, but then my level of certainty is much, much lower. Now, what about investors? And this is what Nikhil mentioned earlier, that I am okay to take slightly higher level of risk. I do not want that kind of volatility what equity is offering. But am I being compensated for it? Will I get some level of higher return? Bonds obviously is one of those options. And I think Grip also offers bonds on its platform. So this is the way in my mental framework I put that there is extremely low risk but low return. There is high risk and a potentially higher return. But what about those investors who are okay with slightly higher level of risk? Unka emergency portfolio create ho gaya hai, FD is there, equity there right now. They do not want to invest, or let's say their equity portfolio is full, already full, and they have additional amount to invest. What should they do? And this entire space is kind of vacant and blank, where I'm okay to take slightly higher risk, but where should I invest? Where can I get FD plus and equity minus return? So this is the way I think about it. So sorry to interject in between.
Yeah, if you can just hold on to that, Rohit. If
Yeah.
you can just hold on to your whiteboard.
Okay, sorry. Sorry, it has gone.
It's gone. Okay, yeah, but very well put, right? There's a fixed deposit and then there is an equity on the top right. And as you start moving towards the top right, obviously the risk increases. And in most cases, these will be also market linked opportunities where the troughs and valleys of market will hit you and you have to stomach those things over a longer period of time. And that's why when we were thinking about such opportunities, they were mostly one, fixed income investing. So how do you provide a fixed income returns? Second, can they be non-market linked? Because there are enough avenues for market linked opportunities. And thirdly, can we provide fixed monthly and interest payouts so that your exposure run down continuously and not holding on for longer periods?
Yeah.
And somewhere in that vacant space, have we found that opportunity, which is called SDI or securitized debt instrument?
Yeah, sure. And I think this is a good time. There are a couple of questions also from Mr. Ilayaraj and one more attendee. What does SDI stand for? And it sounds like an interesting proposition, but I haven't heard much about this product. So this is a good time for you to explain what are you actually talking about SDI? What is SDI?
Yeah, so as I said, SDI is called a securitized debt instrument. But let's start with a very, very simple example. There are NBFCs in India. I think most people who have invested outside of fixed deposits will understand what NBFCs are. Their basic bread and butter business is to provide loans. These loans could be MSME loans, business loans. There are some group loans and personal.
Vaibhav, just a second. So for some of our listeners who might not know what an NBFC is, I'll maybe simplify it. So NBFCs are companies which are not banks. The full form of NBFC is non-bank finance company. So it is not a bank, but it is in the business of providing loans. And some prominent examples, it's a Bajaj Finance. Many of us would have taken our mobile loan from Bajaj Finance, or let's say Shriram Transport Finance, let's say Mahindra Finance, many tractor finance, they are very strong. So all companies which are not banks, still they are in the business of providing loans, are called NBFCs. Sorry, Vaibhav, please continue.
Yeah, no, thanks for that. And since you named some of these NBFCs, right? So the point is that these NBFCs have been providing these loans. They have a huge or considerable amount of history on providing these loans and their collections and NPAs and all those things. So it's a stable, that is happening in the industry any which way. What through a securitized debt instrument or SDI we are able to do is investors or investors on GRIP or investors on Kotak Cherry would be able to buy a pool of these loans. So let's say a Bajaj Finserv has already provided 6,000 granular loans, and I'll come to the loans part also. But from that book, a retail investor can go and buy a part of those loans, which is basically this hands the power to an individual investor to basically invest with Bajaj Finserv or a Shriram Transport. And these investors will buy a book of loans from there, and the loans, when they mature with their monthly principal and interest payouts, would directly be credited to the investors. Very simple example, but the process of NBFC giving these loan book to retail investors is basically called securitization. Okay. There are a few things, like there is a 40% weighted average security cover, which means
just hold on, Vaibhav. Let me just understand it clearly. I will explain in my simple words, and then you correct me if my understanding was wrong. So let's say there is an NBFC. Let's again take the example of Bajaj Finance. Okay. So Rohit and Vaibhav, there were two users who wanted to buy a mobile. They went to the mobile shop, they bought the mobile, they also took a loan from Bajaj Finance for it. Okay.
Yeah.
Now that loan is sitting in the balance sheet of Bajaj Finance. So what you are saying is, when an investor is coming on GRIP, they are actually buying that loan from Bajaj Finance, is it?
Correct. Okay. And the idea is that in your example, there is one Rohit and one Vaibhav. But now when you are doing it, there are 3,000 Rohits and 5,000 Vaibhavs, with the
Okay.
individual exposure being very, very low.
Okay, so it diversifies the risk.
So it automatically diversifies the risk to a very, very granular level.
Okay.
Since
Okay,
we are
yeah. So basically, you're saying that it's a 3,000 Rohits and Vaibhavs are there, maybe 1 or 2 or 3 of them might default, but at an aggregate level, all 3,000 will default. The likelihood is very, very low.
correct, and even for that small percentage, there is a security cover, there's a cash collateral, there is a what we call as FLDG, or first loss default guarantee. Some of those things put into this structure.
Yeah, so
which-
that you'll have to explain to our listeners that how is it when you are saying that these are slightly higher risk, because as a randomly talking about, I don't know who Rohit, who above is, who is taken loan, they might default. How am I protected? So the security part you will have to explain slightly in detail.
Okay, so in all these cases, the NBFC itself puts a security deposit for the investors who are invested in it. So, for example, if let's say the loan book that we have gotten to invest is 1 crore, then 10 to 15% of that will be put as cash deposit or security deposit,
Okay.
or I'm just using some words which are more understandable, like a bank guarantee or a fixed deposit, that will be put by a Bajaj Finance.
Okay.
Now, if you see the defaults range in this kind of loan books, default are less than 1%, but your cash deposit is in the range of 10 to 15%, and that's why
So this is almost like the security deposit that we give to our landlord. Let's say we have not paid the rent, then the landlord can use the security deposit. Is something like that?
I think Vaibhav's net is
exactly like that. Even for a simple, oh, is my voice not clear?
It's fine now,
We
Vaibhav.
lost you in between. So Vaibhav, what I was saying, that is it somewhat similar to, maybe not exactly, but somewhat similar to the security deposit we give to our landlord when we are taking a house on rent, that if we don't pay the rent on time, the landlord will use the security deposit. Is it something like that?
Yeah, it's very similar to that. One of the key things is for a single delay of a principal or an interest payout, the security deposit can be invoked almost immediately. So there's no long process. The structure is created in a way that the security deposit will come into picture even if there is a single delay in this process.
No, this part I understand. And actually, when I first took a home on rent, I always used to think that, boss, I am working in a good company. You can see my salary slip. Why are you asking for such a big security deposit? But then I somehow over a period I understood that I think that I'm a good person and I will not default, etc. But how will the landlord know? So he has to cover his risk. So
Yeah.
I think, yeah. So this part is clear that there is not only the NBFC, when they are doing or giving out the loan, they are doing that pre-selection that only good borrowers they are giving, etc. All of that. So that selection they are already doing, but obviously anything can go wrong. And there are some of those 3,000 people who have taken the loan, which I have bought now as an investor, they can default, but there is a security deposit also. Let's say Vaibhav is defaulting, Rohit is defaulting, immediately that fixed deposit or bank guarantee will be used.
Yeah, I will just add one more point. Like you said, right? The landlord still, even if you're paying the security deposit, landlord still asks, do you work in a good company? Do you have a stable stream of income, right?
Yeah.
The same analogy applies even in these good loans. And why we call it good loans is because the RBI guidelines say that you can only securitize a pool of loans if they meet certain criteria.
Okay.
Like for a landlord, you have to work in a blue chip company. To get securitized, you have to be like never defaulted, CIBIL score, minimum holding period, which means there has to be some seasoning of this loan book, so on and so forth. So we believe that this pool of loans is actually better than the overall loan book of a Bajaj Finance or a Shriram Transport. And that's what makes this instrument very interesting.
Vaibhav, Neil is asking, how is SDI different from the collateralized debt obligations issued by the banks in the US in the 2000s, and that led to the financial crisis in 2008. Maybe you can add to it, but since I have little bit knowledge of this sector, so I will reply to this. Neil, see, in principle, what you're saying is correct. The collateralized debt obligations actually were a magnitude of order slightly, it was a much more complex product. What we are talking about here is very simple, but I think the key reason why SDI in India is very different from what happens in US or maybe some other geographies are the regulatory restrictions that are there in India. Just to give you a sense, it's not that in 2008, when the crisis was happening in US, India did not have a securitization market. It had a securitization market then also, and I think Nikhil is going to explain to us how big this market is in India. But it never blew up in India because the regulations are such that the investor protection is taken care of. And the answer is somewhat similar to why banks in India have never defaulted, whereas there are so many banks in US who have defaulted. Just maybe 6-8 months, we saw Silicon Valley Bank, which was such a big and old bank, it kind of went down under. So if the regulations are created in a manner where investor protection is kind of taken care of, or is very important in the regulator's mind, the risk kind of lowers. Obviously, no one is saying that the risk goes off, but it lowers. A very small example I'll give you, and there are various regulations which are there in India. There is something called as minimum holding period before you can sell off this loan. So there is no such minimum holding period in US. In India, there is a minimum holding period, which means what? That let's say today that NBFC has given a loan, it cannot just immediately sell off that loan tomorrow, because that creates a bad incentive that I am not checking who the borrower is. I have just given the loan and tomorrow I'll sell it off. It doesn't happen that way in India. You have to keep that in your balance sheet and there are various slabs, sometimes 3 months, sometimes 6 months, sometimes 9 months. You have to keep it on your balance sheet. So you are first taking the risk as an NBFC for 3, 6, 9 months. And once that risk is off and the borrower has not defaulted and has always been regular, then only you can sell it off to an investor. And there are various other regulations also through which, so in theory, what you are saying might be correct, but the devil lies in the detail. The investor protection laws in India and all across, not just in SDIs, and if you look at mutual funds, if you look at banks, I think the regulator very well understands that for Indian investors to invest, the regulatory framework has to be very strong. Vaibhav, you want to add to this? How on this point?
I think you have explained it beautifully. Maybe I'll just add one line to it that see, instruments are not bad. It's about what goes into those instruments. Like a lot of junk went into the CDOs in the US in 2008. But as you very rightly said, Indian regulations protect our investors well. So there are already guidelines on which loans could be securitized and which loans can't. So that is well protected.
Yeah.
Just in the interest of time, moving on quickly, I would just take the first 3 points. When we were thinking about this instrument, 3 things were very important for us. The product should be fully regulated. So this is regulated by SEBI and RBI. We want to objectify or quantify the risk. So all products on GRIP or all SDIs are credit rated. So you can choose your risk appetite on where do you want to play with risk and returns. And finally, all returns are fixed monthly payouts, both in terms of principal and interest. So we don't, these are not, long-ended, backdated financial investments. These are actually, the principal runs down very quickly in these products. Other small details are 12 to 18 months tenure, diversified exposure, which we spoke about, and starts with a 1 lakh minimum investment amount. Yeah.
Okay, great. So there are some other questions. I will take it, but I will maybe go to Nikhil. Or Vaibhav, you want to take this?
I just wanted to add, see, here we explained the product. You see that investors graphic in this, but what GRIP has essentially done is brought it to individual investors. but this product has been around for a while. Nikhil, if you can just go, yeah. So this SDI is not a new product. Securitization as an industry is a very large industry. It has been growing, and the numbers stand at astonishing 1.8 to 2.2 lakh crores. And what astonished us as well was that in the last year, in FY 2023, 100 large investors invested a 1.8 lakh crore into such instruments. The instrument that we just spoke about in the last slide, and Rohit was really good at breaking it into very simple things. But this is not something that we are doing today. But HDFCs and SBIs and Axis and Barclays, JP Morgan, financial banks, even foreign financial banks have been investing into this journey. And this is basically journey of Indian economy, because finally these loans are credit enablement in the farthest corners of the country. What GRIP has essentially done with this product is get the same opportunity for retail investors and find that place on the same table, which we call as game changing.
Great.
Yeah.
So there are a few questions. Maybe I'll take it quickly before I go to Nikhil. Someone anonymous attendee is asking, SDI is like earning loan from loan given to others. Absolutely right. It is like earning loan given to earning from loan given to a Rohit or a Vaibhav, but just that it is not one Rohit or one Vaibhav, as we explained earlier. It is a very, very large pool of borrowers, and on top of that there will be a security deposit, etc. What is the expected returns and tenure? Maybe I'll ask Nikhil to cover it when I go to him in a minute. Who has the authority to invoke this security deposit? Vaibhav, you want to take this?
Rohit, I would recommend that we take the questions at the end.
Okay.
Yeah, maybe some of the questions get answered along the way.
Fine. Okay. So we'll go ahead then, Vaibhav.
Yeah. So maybe just Rohit, what I can do is I can quickly talk about.
Yeah, I was coming to it that you kind of explain to us this cool new idea where we can invest in a slightly higher earning with a slightly higher risk. But who are you?
Yeah, normally you start with that, but I think we wanted to get into the topic and then come to us. GRIP, for everyone's information, or GRIP Invest is we are an online investment platform for such high yield fixed income products. Exactly how Rohit explained, we're trying to solve that in between space between fixed deposits and equity. So all kind of fixed income options ranging from 9% returns to 16% returns is what you will find on our platform. We are, what is important, has always been important for us, is to make sure that we get all the appropriate licenses as a platform. So we are a registered stockbroker and an online bond platform with SEBI. We've been on operation for 3 years, and I think that's important for people who look at our products, that we've enabled 750 crores of investments. More importantly, returned 360 crores of investments to people on a monthly basis. Some of our investors, VC investors, are also marked on this page. I think going back to the SDI question and linking to what GRIP has done, we saw the market of 1.8 lakh crores that has been enabled for institutional investors. But GRIP has been on this journey with the SDI for over a year now. And I think we're coming, and the reason I think Kotak also got comfortable to, if I could say it, invite us on this webinar, is to say that this is not a product that came out yesterday, even for a retail investor. It was in October last year that we listed the first ever SDI in India on the National Stock Exchange. And it was obviously a great milestone for us as a company. But since then, we have done 16 SDI transactions, almost 1.5 a month, totaling to 175 crores. And there is a 0% default rate in every single one of them, right? So all of these have been invested in small ticket sizes of 1 lakh rupees by investors, retail investors, through our platform. And I think that is what we are excited about, being able to power and bring or scale more, and sort of is the history of SDI with retail investors. Yeah. So you have the same risk and return as an institutional investor, but available at a 1 lakh ticket size. Maybe just quickly, this is what GRIP really offers or wants to bring to users. We're a completely online experience. exclusive access to SDIs. All products are credit rated, so you know exactly where your risk is. 1 lakh rupees is a minimum ticket size for SDIs and 1,000 rupees for bonds, and demat products with 16% return. So that's a flavor of grip for you, Rohit. But I don't want to take more time. I know we have some questions to answer.
Yeah. So I will take it maybe. So yeah, SDIs I explained, expected returns and tenure. I think you will have multiple options, right? At any given point in time, Nikhil?
Yeah, as of today, there are about 17 options on the platform. We know different people, like you explained, you'll have to have different people in your cricket team.
Yeah.
We want to make sure that you can choose everyone from a Hardik Pandya to a Virat Kohli, and build that portfolio for yourself.
Yeah, and in any case, Nikhil, since for an investor, if they are venturing into a new product, which is maybe over a period they will have better understanding, it makes sense to diversify also. So even though one asset or one product might be looking good, it makes sense just for the benefit of diversifying your risk. You start with 2, 3, 4, 5 assets, and over a period, as you get more comfortable, you can maybe have slightly more concentration.
Absolutely. And if I can add to that, we encourage anyone who's starting on Grip to start with a small ticket size, right? Experience the product. If it's your first investment, especially, start with a small product. We've really focused on making ticket sizes accessible. And I think the second part to that is that also to have comfort, please know that you are now, when you invest on Grip, you're investing directly with the National Stock Exchange. I think that's a really important point. And credit to SEBI to design and enable a framework like this. All of us are
a settlement mechanism that if I am putting my money out, I am 100% sure that the security will come in my demat account, just like it happens in shares. That if I'm trading with my broker, 100% sure that the security will come to me.
Absolutely. So none of us think twice about investing to buy stocks because we know the money is secure. And the stocks will definitely come. I think the same thing is now happening. And Grip is happy to have integrated with the National Stock Exchange to enable that settlement. So I think the comfort of small ticket size, experimentation, and settlement comfort, I think is what is possible today.
Yeah. I think Atif was asking how has been the performance of the SDIs in the last 12 months that you've already covered, Nikhil. It has been good, no defaults. I think this question, Nikhil, if you want to take, if an investor is making 13% on these products and 10 to 15% is put into cash by NBFC, how much is the NBFC charging the original borrower?
Yeah. No, I think it's a great question. The NBFC actually ends up charging the borrower anywhere between 20 to 25%, depending on the kind of loan it is. There could be personal unsecured loans, which could be 25%. There could be business loans, which are around 20%. And what the NBFC is saying is that I know I have done my job and this loan will not default more than 1 or 2%. Hence, I'm ready to put my skin on the line or my business on the line and put down 10% of money to make sure that you feel comfort, because you don't know the borrower. I know the borrower as an NBFC. So I think that is the equation that plays out. The good thing when we all win is that there is no default. The NBFC gets its 10% security deposit back and we make our 13% return, right? So the NBFC has far more visibility to take that risk, and that provides you as a comfort from a security deposit point of view.
Yeah. Okay, great. Atif has a follow-up question. Can I access these SDI products on Kotak Cherry? Atif, right now we have just bonds on Kotak Cherry. SDIs over a period we introduced because some of these integrations, for example, this NAC integration, which Nikhil told you about, our application is still under process with SEBI. So maybe over a period of time, we will also look to introduce. As of now, we are having only bonds. And if you are interested, maybe you can chat with the Grip team. I'm sure they will have a customer service team. You can chat with them and they will help you out. Great. So we have something else after this, Nikhil, or it's...
No, I think that's our side. Yeah.
Hey, Rohit, you asked me a question, or I still see that question on the list, and it's a really good question. Who has the authority for everybody?
Yeah, sorry, I missed that. Yes.
Yeah. Who has the authority to invoke the security deposit, Grip, or the investor? Yeah, so a good question. I didn't go into too much details of the structure, but Ankit, there is a SEBI registered independent trustee which issues the pass-through certificates or the instrument, and all cash flows are managed through that trustee. That trustee also acts on the behalf of investors. So that trustee has the authority to invoke the security deposit if at all the need arises. GRIP.
And Vaibhav, what I heard you telling, it is almost like an automatic process. No one has to do anything.
Yeah, so the trustee can invoke it at a push of a button.
No.
That's if it were a GRIP or the NBFC or someone else, there would be a process involved. But because there is a trustee and the cash flows are all escrowed, they have the direct access to invoke the security deposit if that happens.
I think if I could, draw a parallel, given Rohit, a lot of your users are investing in bonds. Every bond also has a similar trustee, right? Where all the cash flows are managed through and returns are processed. That structure is replicated in an SDI. This trustee is not just any private limited company, but is actually a SEBI regulated and license holder company. So it's completely independent. There's no relationship to GRIP or to the NBFC, and hence acts only in the interest of the investor.
Yeah, so since you spoke about bonds, actually what happens is, and I must explain why this trustee mechanism is there in place. It is exactly because, let's say in bonds also, there will be thousands of investors, okay, who are part of the same bond tranche. Tomorrow there is a problem. Now it is almost impossible for all those thousands of investors to go and represent, let's say there's a court case, etc., all of that, who will do? So the trustee is the representative of investors. That if, let's say, a court case has to be filed, or let's say cash flow has to be managed, it is as simple thing as if you haven't got your TDS certificate, you can always go to the company, but you can also go to the trustee, send a mail that I have not received my TDS certificate. So it is a representative of investors who's doing it on behalf of the investors. Great. I think we are on time, Nikhil and Vaibhav. We are almost done. So great. Thanks a lot again coming on the, I think it was a very engaging conversation. I see almost no one dropped out from the start. So all the participants have been throughout there. So thanks again for joining, and maybe we'll catch up again pretty soon. If you have something more interesting to share with us, maybe in a couple of months, you can tell us how many more milestones you have crossed and how many more investors you have kind of touched base with.
Absolutely. No, Rohit, thank you so much for hosting us and for making this so engaging. It's been terrific getting the questions from you. And I'm going to tell you in advance, we're going to copy some of those analogies to explain what SDI does. So I'm giving you fair warning. But thank you, and lovely talking to this audience.
Yeah. Thanks a lot. Thanks.
Thank you. Thank you so much, Rohit. And thanks everybody for attending on a weekend evening.
Yeah. Bye.
Thank you.
Okay, bye.
Investments in debt securities are subject to risks. Read all the offer-related documents carefully.